Closing bell with me, Nandita Khemka, and my colleague.
Hello there, I'm Yatin Mota.
Well, Yatin, not a terrific Tuesday, and not a happy trading day, so to say, given the
Absolutely.
fact that we've seen broad-based weakness across the mid-cap universe, the benchmarks as well. The Nifty, first of all, has slipped below that 24,400 mark. The mid-cap saw deeper gashes, 2.2% cut on the mid-cap index, almost a 1250-point cut when it comes to the mid-cap index, and breadth was extremely poor. The NSE advance decline ratio at 1:5, just 400 advances to 2,200 declines. So yes, the breadth was extremely poor, and lots of result reactions as well. We saw some of the stocks plummeting somewhere around 10% or so post their numbers. We'll take stock of them. But in terms of sectors, PSU banks deserve mention. The index has slumped for 5% or so. I think it has broken below some key
Yes.
support levels as well. The Nifty Bank Index also under pressure, 54,270. That's where the Nifty Bank Index is at, lower by about 650 points or thereabouts. All the sectors, barring the auto pack, were trading in the red. The auto pack just about managed to end in the positive territory. But if you look at the Nifty gainers, the top names would be a mix of FMCG and auto names. So you had the likes of Hero MotoCorp, M&M, Eicher Motors, Maruti. All these stocks were among the gainers, and you also had the likes of HUL and some of the other names like Nestle that were on the gainers list. Aside of that, you had Tata Steel as well doing well. M&M, as I mentioned, JSW Steel. HCL Tech, Apollo Hospital, Bajaj, Finserv, Ultratech Cement, these were among the other notable gainers. But in terms of laggards, Adani Enterprises down 4% yesterday. The Adani twins were among the top gainers. And today, Adani Enterprises is the top Nifty laggard. Geo Financial is a close second, 3.5% cut on a Geo Financial. Eternal, that had seen a good run up until now, it's down somewhere around 3%. And so is Trent. That was among the top Nifty gainers yesterday. And today, has shed somewhere around 3% or thereabouts. Life insurers like SBI Life, HDFC Life under pressure. And of course, pharma names also under pressure after Trump had signed executive order to boost domestic manufacturing in the US. So that comes as a setback, but more clarity awaited. And we'll have to see whether or not there are some pharma tariff announcements in the upcoming weeks or not. So yes, that was the overall market texture. Not a great day in terms of trading action. US futures were also in the red, and mind you, the Fed meeting kicks off today, the two-day FOMC meet. Although expectations are that the Fed will, stand pat on interest rates, but it's the commentary from Jerome Powell that will take center stage. But Yatin, quite a few numbers, and the likes of Bank of Baroda plummeting, and how taking the entire Nifty PSU Bank Index down with itself. Tell us something about the numbers. What was so much disappointing in the numbers?
So, before we talk about the mid-cap gainer losers, Nandita, clearly the PSU Nifty index is down 5% below 200-day moving average, and the key moving day averages are taken off. And since SBI reported numbers, we have consistently seen PSU banks under pressure. Now, let me sum up the numbers for Bank of Baroda, which was down 11% in trade. Why? Because, their profit growth was only 3% year-on-year basis. Net interest income has declined 7% year-on-year. And if you look at the net interest margins, which is a key parameter for banks, since, everything is good on asset quality, the margins declined by nearly 8 basis points QOQ. To come in at 2.86%. Estimates were nearly 2.9 to 3%, but clearly the margins have come below expectations. If you look at the advances growth, that was 5% sequentially, and slippages ratio for the quarter increased to a level of 1.1%, which was 0.9%. So, the slippage ratio is increasing. Your net interest income is below expectation. Your net interest margins are below expectations. And in a market where people are expecting better results from PSU banks, a lot of rally in the PSU banks has happened because there was growth. And if you speak to a lot of fund managers, everybody was overweight financials. SBI is disappointed with numbers. Kotak Bank is disappointed with numbers, and now joining the ballet is Bank of Baroda. So except for HDFC Bank and ICICI Bank, I think most of the numbers which have come in from the banking space, irrespective of private or PSU, has disappointed, and hence the kind of weakness that we saw in the PSU Bank Index, down by nearly 5% intraday.
That's true, Yatin. I was talking to big market voice Sunil Subramaniam today, and there's a whole debate of now that the report cards have started
Yes.
trickling in,
Yes.
whether one should stick to those large cap private names, or how should one really navigate the entire banking space right now. He also is of the view that long term, of course, PSU banks are good,
Yeah.
but in the very short term, 3 to 6 months time frame, if you're looking at,
Mhm.
in that time frame, private banks are much more better poised to navigate even the margin challenges,
Mm.
because even SBI for that matter has alluded to the fact that the rate cut cycle is on, and another 50 basis points will come from RBI, and there will be pressure in terms of margins as well, but private sector banks better poised to weather that challenge. But Yatin, what about the other movers from the mid cap end? There were
Mm.
quite a few of them.
Mm.
Take us through some names.
So, from the results, boys, we had CCL Products. That stock gained 17% after, strong numbers this time in Q4. So, that was clearly the stock of the day. Other stocks like Godrej Agro, Seed, Chambal Fertilizers continued to rally, 4 to 5% rally seen there. However, Sonata Software continues to fall. That stock was down 9%. Manyavar was down 7%. Union Bank, PNB, all of these stocks down anywhere between 5 to 7%. So, obviously, in the losers list, you will find a whole host of these PSU banks. And stocks like Coforge went up 4% intraday, but ended the day lower by percent. So almost a 5-7% kind of a decline for Coforge post the quarterly numbers. But stocks like Bharti Airtel, Chambal, Seat continue to hit that 52-week high. But Raymond and Manyavar, these are the two fashion stocks, if I may put it so, at 52-week lows, both down nearly 4-5% intraday today.
All right, then not such a fashionable day for some of these fashion related stocks. But let's talk about Coforge that you mentioned, Yatin. The numbers were fairly good,
Hmm.
and even the outlook was pretty good. But I think the stock succumbed to selling pressure amid a broad-based sell-off in the market. Taking it through the numbers, they were pretty okay. The net profit was up 21% on a quarter-on-quarter basis. Revenue also rose almost 5%. Margins beat estimates at 13.2% vis-a-vis 11.9% sequentially, and operational performance was slightly better than what the street was expecting. The board has also, approved a stock split in the ratio of 1:2, the record date for which is on the 4th of June, and the deal intake was at an all-time high of $2.1 billion. So yes, all in all, it was a good quarter, and the outlook provided by the company is also pretty good. They do not really provide any revenue guidance, but it does expect to do better than the earlier $2 billion target that they had outlined in terms of revenue for FY27. The management has said that they expect to better that figure of $2 billion as well. Now, let's come to the street reaction as well. Most of the brokerages have maintained their buy call on the stock. Target prices have also been raised quite a bit. For Jeffries in particular, the rating is buy on the stock, and target price has been raised to 9,000 rupees from the earlier target of 7,860 rupees. They've said that the CC constant currency revenue growth of 3.4% on a quarter-on-quarter basis was the key positive surprise. Because some of the other names in the IT space have disappointed in terms of CC revenue growth. So yes, Coforge did spring a positive surprise on that front, and Jeffries also believes that the strong growth that the company has displayed in the quarter gone by is expected to sustain going forward. They've maintained their FY26 to FY27 estimates, and they're expecting 23% compounded annual growth rate in EPS terms over FY26 to FY28. And consistent execution and strong growth outlook should also support valuations going forward. Now, Motilal Oswal, also buy rating, but here the target price has been raised to 11,000. That shows that the stock has an upside potential of somewhere around 47% or so, because the stock has already seen quite a bit of correction. If you look at the YTD performance, it's down 22% or so. And Motilal Oswal has also said that the recent Sabre deal that the company has inked is signaling mid-tier companies, IT companies' edge in terms of winning cost-saving deals. And in terms of the tier two players or top picks in the tier two IT space, Coforge is among the top picks for Motilal Oswal. They've also said that the strong deal TCV indicates robust near-term growth outlook, and they are valuing Coforge at 38 times FY27 EPS. They've also said that Signity may prove to be an effective long-term asset for the company. Remember when they had made this or announced this deal with Signity, there were a lot of worries whether or not there was any revenue visibility in terms of this deal or not. But that has been put to rest, and Motilal Oswal is saying that it could prove to be an effective long-term asset for the company. Even other brokerages like Nuvama have buy calls with target price anywhere between 9,400 or 9,500 or so. And all in all, the view on Coforge is pretty much positive. As I said, the stock is down 20% in 2025 so far. But if you look at the last 1 month performance, the stock has managed to stage a good rebound of 15 to 16% or thereabouts. Yatin.
Absolutely, and Coforge, that is one stock which saw intraday profit taking from the recent lows. I think we have seen a good bounce back in Coforge and the stocks like Persistent, and clearly, on the valuation front, most of the brokerages feel that Persistent as well as Coforge have been on the richer side of the valuation versus the large cap peers. But talking about the real estate space also, which is kind of doing well, but this year post we saw Godrej cutting their real estate guidance. I mean to say Godrej Properties. Clearly, other stocks are also nervous. Today we had Suntec Realty also looking slightly nervous in trade. In fact, today we have Jefferies, which has cut the target price on Suntec Realty to a level of 575 from the earlier level of 685. FY25 for Suntec saw 32% kind of growth because of the new launches that they've done in the luxury segment. However, the company is expecting a similar growth rate in FY26 also. However, collections have been lagged due to delay in project completion. So delay is a concern. Also, if you look at the company, they are looking to launch new projects as well as Q4 was a record number for the pre-sales figures. So whether or not the real estate rally sustains is something we'll watch out for, since FY25 was a great year for real estate players in collections, in launches. How do they really take the momentum in FY26 given the macro and geopolitical uncertainty will be something we'll be watching out for. But yes, brokerages have cut the target price by 110 rupees on this particular counter.
Okay, brokerages have cut targets and the stock was down, and the entire realty pack was on shaky ground today. I think the realty index, in fact, has lost 3%, in excess of 3% in today's session. The other stock on my list is Indian Hotels. Though the numbers were pretty good, Street is fairly cautious on this stock, which is why we saw a 6% cut on the stock, post numbers. Despite steady earnings. In terms of profit, they saw a good, healthy 25% uptick. Revenues also grew somewhere around 27%. Margins were also higher if you compare it with last year, 35.3% vis-a-vis 34.6%. So yes, there was nothing as such wrong in the numbers, and even the outlook was pretty buoyant, given the fact that the management has guided for double-digit top-line growth going forward of 12 to 15% or thereabouts. But there is some bit of caution on the street in terms of valuations also. Where Nuvama flagging off that the stock has run ahead of its earnings, which is why they have a reduced rating. But in terms of management commentary, they are expecting 25 to 35% growth from their reimagined business in FY26. In terms of areas, they've said that Goa is the only place where occupancy is not increasing, but Delhi, NCR, and Mumbai region remain very strong in terms of demand. Now, IHCL is also reimagining its hotel brands, from where, of course, it is expecting 25 to 35% growth, wherein they are, reimagining brands like Ginger to attract a broad range of travelers, including the younger generation and more budget-conscious travelers. They've also earmarked, in the past, Accelerate 2030 strategy that aims to significantly expand its hotel portfolio and double its consolidated revenue by 2030. Now, this growth will be driven by scaling existing brands as well as expanding into new regions and internationally as well. Now, the management has said that they are looking at much more openings in the next 2 years. They are looking to maintain their margins at current levels of 35 or so, and they will be looking to find a balance between margin, investments, as well as growth. In terms of capex, for the year, it's guided at 1,200 crore rupees, focused on a mix of greenfield projects as well as renovations. In terms of street view, most of the brokerages have also retained their existing calls on the stock. Looking at Jefferies, they have a buy call. Target price, however, has been cut slightly to 980 rupees from 1,000 rupees. The sector outlook remains positive. That's what Jefferies has pointed out, because the hospitality sector is believed to be in an upcycle, due to strong domestic demand, and supply has been limited, so to say, which is why the outlook on the hospitality sector is pretty positive going forward. And for Indian hotels in particular, Jeffries is expecting EBITDA PAT CAGR of 16 to 18% over FY25 to FY28. But Macquarie is a little cautious. They have a neutral call here, and the target price is sub 850 rupees. It's at 820 rupees or so. They have pointed out that the company has missed expectations in terms of EBITDA. And they've said that there has been a reduction in their project pipeline for FY26 and FY27, a 10% reduction, which is why they have maintained their neutral call and are a little cautious. On the other hand, Motilal Oswal, that's quite bullish on the stock with the target price of 940. They are expecting, key drivers in terms of FTA growth, as well as the wedding dates that are, they've pointed out that there are 70 plus wedding dates that are evenly spread across the year. Plus there is a strong room addition pipeline in the management hotels, key renovations in hotels like Taj Palace Delhi, Taj Calcutta. All these renovations will also yield results going forward, which is why they have reiterated their buy call. So all in all, there's mixed view on Indian hotels. Nuvama and Macquarie are a little cautious, but brokerages like Jeffries and Motilal Oswal still have faith in Indian hotel. All in all, nothing wrong with numbers, but
yeah, I think it was a general profit taking. I think, as you said, nothing wrong in the number. Commentary was also good. In fact, they're expecting price growth, new projects getting online. But yes, I think broadly the war situation plus the kind of stock run up that we have seen since COVID is great.
Yeah.
I think largely some profit taking, and probably the reason why the stock was down 6%, almost closing at the day's low.
Well, those were all the stocks on our list this afternoon. Then, not a great day when it comes to trade, but let's see, tomorrow's another day. And tomorrow night is when we get the Fed decision. Let's see how global cues also pan out in the run up to the Fed decision. But completely timed out on closing bell. Come back and join us tomorrow morning at 9 a.m. on opening bell. I'll see you then. But for now, it's a goodbye. Thank you for watching and have a great evening.
Good afternoon and welcome back to Moneycontrol's live stream. You're tuned into Closing Bell with me, Lavisha Darad. So once again, a very choppy session seen in the markets, and in the last 15 minutes, the market completely turned red and we snapped the two-day gains that we made earlier. Sensex closed flat in the red and Nifty was also flat in the red, although it did hold above that 24,300 mark. But however, if we look at the the entire breadth of the market, that was in favor of the decline. So advanced decline ratio that stood at 1:3. So declines clearly had an upper hand. On the other hand, if you look at among the sectoral indices, Nifty PSU index, the top sectoral laggard, led by the weakness in SBI ahead of its Q4 results, which is due over the weekend. Otherwise, majority of the sectors also flipped in the red, apart from Nifty Infra Index and Nifty Pharma Index and Nifty Realty Index with about 2% gains or so. So yes, all three indices. Nifty Auto Index also has ended flat in the green at this point of time. If you look at the broader end of the market, small cap and mid cap indices have seen larger cuts of about 0.7% to 1% or so. So yes, clearly the breadth of the markets definitely had plenty of weakness. If you look at the India VIX, that jumped about 4% or so, nearly 5% uptick that can be seen. So it denotes that there is some kind of fear and caution in the markets after the rally that we have seen in the past 2 days. But to decode all of this, let's quickly get on board with our guest of the show. Joining me is Nilesh Jain, VP Head Derivatives and Technical Research of Centrum Broking. Nilesh, so good to have you. Past 2 days, we're seeing choppy session, and in the last minute or so, 15 minutes or so, we are completely flipped in the red. What is keeping investors nervous at this point of time?
Hi, Lavisha. Very good afternoon to you. Today, if you see, we have seen more sort of a consolidation, at least till the first half of the session, where we saw some bit of consolidation similar to what we saw yesterday. But towards the closing hour, we have seen in fact, 15 to 20 minutes, we have seen a sharp decline. And yesterday was a reversal candle, look like a shooting star kind of candle we have seen in both Nifty and Bank Nifty. And today we have seen a follow-up on the lower side. So overall, on the back of a weekly FNO expiry, some unwinding was also seen from the put strike. So looking at the overall setup, it looks like we are likely to witness some bit of selling pressure going forward. Even if you just look at the volatility index India weeks, where we have seen a constant uptick in last 4-5 consecutive sessions from the levels of 15, it has surpassed 18 mark today, and currently it is near about 18.5. It is at elevated level and is a cause of concern as well. It needs to cool off below 16 for bulls to regain the control, but as of now, looks like we are likely to witness some bit of selling pressure at the high levels. Even if you look at in the Nifty, the RSI has given a bearish divergence, kind of a negative setup, I would say, where RSI has started making lower highs and lower lows, lower top and low bottom. So overall, looks like Nifty should test 24,000 going forward. Till time it doesn't break above 24,500, the setup looks negative. Similar is the case with the Bank Nifty as well. Yesterday it formed a shooting chart. Today we have seen an underperformance in the banking space as a whole. So we are expecting a follow-up move to continue towards 54,500 to 54,300 on the lower side in the spot levels, and 55,300 is the important resistance zone.
Okay, Nilesh. Nilesh, what about the defense stocks? Because even that saw a bit of cool off today. And given the kind of run up that we have had past 2-3 days on account of border tensions, do you believe that this could be sustainable going ahead?
Right. So, Lavisha, if we just look at the structure of the defense space as a whole, be it HL, Mazgaon Dock, in fact, these two stocks have witnessed a good momentum recently. But now, if you just look at today's move, it is kind of a merely a profit booking, I would say. The major undertone still continues to remain on a positive side with the band decline approach. And our preferred bet within the defense pack would be Mazgaon Dock, which has hit a new record high today, although some profit taking was seen, but the major structure for Mazgaon Dock looks strong. And we are expecting this counter to move towards 3250 to 3350 on the upside. So with a stop loss below 2850, any dip from here can be used as a buying opportunity. Since we have seen a good spurt in last 2-3 sessions, so some profit taking that cannot be ruled out. But from here, any dip should be used as a buying opportunity.
All right. Let's talk about one stock in focus that was your top Nifty laggard also, Bajaj Finance. After investors were unenthused, given that the company trimmed its growth guidance for FY26, and that's what disappointed investors. Nilesh, how would you suggest investors to approach the counter now that they have also announced a stock split, bonus issue, and even a special dividend?
Right. So today we have seen a result back in this particular counter, but if you just pull up last 6 months, 1 year chart, you can see the counter has been in a strong uptrend, and this correction is giving a good opportunity to start accumulating this particular stock. But there could be possibility of some short-term impact because the stock has broken its important support. Today we have seen a build-up on the short side as well with the OI addition of close to 9%. The stock has broken below its 50 DMA as well as 21 DMA. So short-term structure is indicating the counter may test the levels of 8,500 to 8,400. But positionally, we expect this stock to move towards 9,000 again, but that will take some time. But at present, it's an avoid. If at all it falls in the range of 8,400 to 8,200, that can be a bargain buy.
Okay, 8,200, that's where it could be a bargain buy. Let's take another stock in focus. That was your IndusInd Bank, because it did recover about nearly 3% from its day's lows after RBI approved an interim leadership team to ensure there is an operational continuity after MD and CEO did resign from his post. But Nilesh, given the uncertainties which we are having surrounding the lender, and several brokerages are also pegging the lender to report a weak set of Q4 numbers. So what's the next downside we can anticipate or we can watch out for?
Stock did make an attempt to witness some bit of rebound after a carnage that we saw in this particular counter on 11th of March. And after that, the stock tested the lows about 620 to 630 zone. And from those levels, we have seen a good gradual up move. So there could be possibility of some bit of consolidation, but it is not looking it is not giving any sort of a confirmation of a trend reversal as of now. It is merely a consolidation that we are witnessing with a gradual up move. So it's an avoid from our side in this particular stock. Better not to trade from a short term perspective. Better wait for result to span out. And as far as levels are concerned, 775 is an important support on the lower side. I would wait for a breakout above 900. If it breaks decisively the level of 900, then it's a buy. Buy for the target of 980 to 1050 if it breaks above 900. Till then, I would be waiting and watch out for the result as well.
Okay, watch out for the results for IndusInd Bank. But yes, one stock that did react to its Q4 results, that was your Varun Beverages. We saw that from day's lows, the stock recovered nearly about 1.5%, and it reacted positively to its Q4 results, although it did end with a cut of about 1.6%. In Q4, we saw that the profit rose about 35% year on year, and revenue was also up by about 29% year on year. Nilesh, what do you think about Varun Beverages? Do you believe that it is the right time to accumulate? Because several brokerages earlier had pegged a target price of about 800 rupees for Varun Beverages.
The stock is facing multiple resistances. It is trading well below its long-term 200 DMA, which is placed at 570, and it has also broken below its 121 DMA as well. The momentum indicators and oscillators have also given a sell crossover, so that is a negative sign. Today's fall was also accompanied with a good volume. So the structure is basically indicating that stock may test the levels of 480 on the lower side. So it's an avoid taking any contraband present level and wait for a breakout above 560. If it breaks 560, then only it's a buy. Otherwise, it's an avoid at current level. We are expecting further downtick to continue towards the levels of 500 to 480.
Okay, all right. Currently an avoid for Varun Beverages too. Let's take another stock in focus. That is your Vishal Megamart, because it did hit a 10% upper circuit after its Q4 results. Nilesh, how do we expect the stock to perform from here on? Its record high levels is at 126 rupees. Can we expect it to breach its record high levels soon as well?
Today we have seen some bit of impact positive on the positive side in this particular counter. The stock is currently trading at 118 rupees. Looking at the structure of previous 6 months, it looks like more sort of a rounding bottom kind of a formation. So a gradual uptick is something that we can expect that may take this particular stock towards 125 to 128 in the near term. But since we have already seen a good spurt, so it's an avoid because the risk and reward is not favorable. If at all you see any dip towards 112, 110, that can be a good buy. But as of now, it's an avoid. Those who are already holding the wrong position can continue to ride this momentum, and it has a potential to test 123 to 128.
Okay, 123 to 128. Let's take another stock in focus. That was your Ujjivan Small Finance Bank after it reported a weak set of numbers, and the stock did react to it, seeing a cut of about 3% or so. Nilesh, how do you see other microfinance lenders in the space also, be it the likes of Credit Access or even Jana Small Finance Bank? Is it a clear avoid at this point of time?
As far as Ujjivan Small Finance Bank is concerned, it's an avoid. Reason being, the stock has gone into extremely consolidation kind of zone, I would say, where the stock is facing a constant resistance 45 to 46 zone, and it has a very strong support at 75. So that's the broader range, 35 on the lower side and 46 on the upside. So if it breaks 46 level on the upside, then we can probably see a bottoming out of process in this particular counter. But as of now, it's an avoid Credit Access as well, because this particular space is going through some bit of pressure, and this pressure is likely to extend further for next 1 or 2 months as well. So as of now, we are not advising to buy. We would like to wait for a confirmation on the chart.
Okay, all right. Confirmation on the chart. Let's take another stock in focus. That is your C8. After it reported its good set of numbers, the stock was also at 4-month high and it has ended with about 6% gains. Nilesh, brokerages have attributed the company's effective cost management, and they expect that other tire companies are also expected to benefit going ahead. We saw the likes of JK Tires, Apollo Tires also reacting well after C8's results. So, what do you expect? How do the tire stocks look like on the charts for the short term perspective?
Well, Avisha, all these three stocks that you have just pointed out are looking strong on the chart. CEAT has given a good spurt of over 7% today. The structure-wise, it looks like it is heading towards 3,500 in the near term. But at present, it is not advisable to buy. Better wait for some dip towards 3,100 to 3,000. That can be a good entry point for this particular stock with the stop loss below 2,800. Our target from a short-term perspective is somewhere around 3,500 plus. Now, coming to other tire counters, we are also liking Apollo Tire. This particular counter has formed a good base formation, and I would say a rounding bottom is also in the process of making. So from here, we can expect another 8 to 10% kind of move on the upside, which may take this particular stock towards 500 to 520. So with a stop loss below 445, any dip can be used as a buying opportunity. Apollo Tires, yet both the stocks are looking positive, and also JK Tires is also looking like witnessing a catch-up move in this particular space.
Okay, all right. Let's take another stock in focus. That was your Shoppers stock after it reported a weak set of numbers, and the stock did end with a cut of about 6% to 7%. And even Trent, if you look at another retail stock, that also did not impress investors a lot. Nilesh, how do you see all of these retail space on the charts, be the likes of Aditya Birla Fashion or even Trent or even Shoppers stock, which has reacted quite weakly, responding to its weak set of numbers?
In fact, all these three stocks are witnessing almost similar kind of structure, which is on the downside. Now, coming to Shopper Stock, the stock is in a gradual decline. We have seen highs near about 900, where a double top formation can be seen in the month of September 2024. And since then, it's a kind of a gradual decline in this particular stock. Structure is looking weak, and we may see further downtick towards 490 to 480. So it's an avoid. And also, as far as Trent and ABFRL, both the stocks are concerned, both the stocks have a similar structure of continuation of a low top and low bottom. So Trent looks weak for 5,000 kind of levels on the lower side. ABFRL is also looking slightly on a weaker side. Out of these three, if at all I have to pick any particular counter, that would be ABFRL. Comparatively, this particular stock has a better structure. But still, at present, I would avoid, if at all it falls in the range of 250 to 48, that can be a good entry point.
Okay, all right. Just one last question before we let you go, Nilesh. What would be your picks at this hour? We're seeing a bit of caution in the markets. We've seen a good run up also. What would you be buying right now?
Right. So insurance pack today witnessed a good momentum, and given the kind of volatility that we are witnessing in the market, where it looks like we may see another round of selling going forward. So the focus will shift towards a defensive. So insurance space, specifically HDFC Life, this particular stock is looking strong on the chart. The structure is basically indicating that the stock is likely to test the levels of 760 to 775 on the upside. If you just pull up last 8 months chart, it is forming a good rounding bottom formation where the major resistance of neckline is placed at 760. If it breaks above 760, then target would be somewhere around 850 to 900 as well. But at present, our short-term target is somewhere around 760 to 775 with a stop loss below 720. HDFC Life is a buy. Apart from that, we have seen good momentum in oil and gas space as well. IGL, MGL, both the stocks are looking positive on the chart. IGL we are preferring this particular counter because today we have seen a good OI addition as well as good volume activity can be seen in this particular counter. So with a price target of 200 plus, IGL is also a buy. Keep a stop loss below 185, and the short-term target would be 200 to 210.
Okay, all right. HDFC Life, IGL, MGL, those are the stocks that we need to watch out for. But with that, we have to let you go, Nilesh. Thank you so much for your time and for the rest of the queries.
Thank you, Lavisha.
All right. With that, we've come to an end of this edition of Closing Bell. Tomorrow is a trading holiday on account of Maharashtra Day, so we'll be back with markets on Friday. For now, it's a wrap. Thank you for watching.
IMF last month noted that the Indian economy will grow slower at 6.2% in FY26 compared with 6.5% projected earlier. World Bank had a similar prediction for the Indian economy. As the world struggles from rising geopolitical uncertainties due to tariff war, how much risk is there to India's growth, especially with the storm closer to home brewing? Moody's ratings yesterday noted that escalating tensions are unlikely to impact India's economy. But a war is never good business. So, how fast can India grow amidst multiple crises? Welcome to Beyond Averages, our weekly data podcast where we try to decode the story behind the big numbers. Today we have with us Gaura Sen Gupta, Chief India Economist, IDFC First Bank, and Paras Chasrai, Associate Director, India Ratings, to decode the health of Indian economy. Thanks for coming on the show, guys. But before we move to our experts, let's first do a status check on the April numbers that we have for now. If you look at it, GSTA collections touched a new high in April of 2.37 lakh crore. This was up from 1.96 lakh crore in March. And if you look at it from last year, it was 2.1 lakh crore. That's about a 12.6% increase, which is in itself a 17-month high. Moving on, UPI transactions were also closer to the 600 million mark, with a 34.5% growth from the previous year. Also, the transactions were also higher in terms of value terms, near to 80,000 crores. So where are we now? In terms of manufacturing activity, we have moved higher and reached about a 10-month high at 58.2 from 58.1. This is on PMI. So how's India performing? Let's first go to our experts to understand. What do you make of April numbers? Are they on expected lines, or is this more a tariff-related bump? Gaura, first to you. Thanks for coming on the show.
Thank you so much. So I agree some part of the pickup in April may be related to the tariffs. For example, you see India's merchandise exports, non-oil exports month on month saw a 20% jump. The other aspect is also the fact that if you see for the April last year, we saw a similar year-on-year pickup. So this is a combination, I would say, more a seasonal, because the April GST collections are for transactions that are done March ending. So usually March end, the Q4 quarter, you see a pickup in transactions. So both goods and services. So usually April numbers, the collections are on the higher side.
Paras, coming to you, is this momentum likely to continue in this quarter, and will it continue for the rest of the year as well? And what do you make of these numbers? Thanks for coming on the show, first of all.
Thanks for having Aisha. So yeah, as Gaurav mentioned, I mean, this is something which is a seasonal thing, in the sense that March is generally a period when we see a lot of targets being met by various firms and consumer transactions as well. So that's why there is a high bump up which is seen in April. But to coming back in terms of the momentum for the quarter, we think that the tariff impact that would be there. I mean, so far, the domestic levers are very strong for the Indian economy, because if you see the growth of real rural wage growth also, that has also remained positive in January and February, and with a good crop season and also the IMD's forecast of above normal rainfall, we think that agriculture would also be doing good. So consumption demand would be the biggest strong domestic factor, and that would be like help. So as to say, to manage the external front, where we see a lot of volatility, especially. So there, I mean, we think that we think that the moratorium that is there in tariff discussions so far, we are better placed compared to other economies. So in terms of coming back to the overall growth numbers, we have kept it at 6.6. So far, but yeah, there are like various headwinds, especially with the kind of movements and data developments under there. But nevertheless, India remains the bright spot amongst various major economies.
Now, coming to those numbers, when you say domestic economy is going strong, let me show you a graph here, which is the interesting part. India is a bright spot in manufacturing in terms of PMI at least. 58.2 was India's number. Australia was 51.7, which also rose during this month. China declined at 50.2. Eurozone 49 was high, but it was still in contraction zone. 50 is the line that separates contraction from expansion. And all the other economies here were in contraction. So India did stand apart from others. Moving on, the fastest growing economy aspect of India. 6.5 was the growth last year, which is projected. 6.2 it would be this year. Look at China at 4. That's a big fall. World, which is 2.8. US is 1.8. UK 1.1 and EU at 0.8. So coming back to Paras's point, we are doing better. Now, IMF revised its India's forecast downward, so did the World Bank. But the projections for now keep India's growth at over 6%. Can it fall below that mark, Paras?
Currently, it looks, not something which looks to be on the horizon, because agriculture, even though it is not a very significant part of the economy, but it employs almost the largest proportion of the Indian economy in terms of labor force. And that's why if we expect, we had also published a research report also that with the IMD's forecast of above normal rainfall, the agricultural growth is also expected, and it could go near the 4% mark and even above that. So, and that will have spillover effects in terms of better rural wage growth, and further ripple effects would be seen in a better consumption demand also in FY26. So, with that happening, it looks, yet difficult that the growth would be slipping below 6% mark. But yeah, the fluctuations regarding forecast has been 6 to 6.5%. So overall, we think that it would be hovering in that range only.
Gaura, coming back to you with the same question, adding a few points to what Paras said. When we talk about consumption demand, a large part of it is also expectations. A war in the offing or an escalating of tensions in the offing, global trade uncertainties, consumption might not pick up as much. Also, the government's recent CapEx survey put CapEx by private sector at 25% below, 4.8 lakh crores from 6 lakh crores, near 6 lakh crores in FY25 expected. What do you think of it? Can it fall below 6%?
So private corporate capex is expected to be weak. It's been weak even last year because there was uncertainty on domestic demand. Now with the tariff situation, you also have uncertainty externally. But yes, the one near-term benefit is that the tariffs on India compared to China are are on the lower side, and India has a better trade relationship with the US and is likely to reach a sort of an agreement with the US. So that will help limit the tariff tensions to merchandise, prevent it from spreading into services. But overall, US will continue to target China, so your global growth will be weaker. So overall, we do expect on a net basis, Indian merchandise exports will tend to be lower in FY26. So when you have this situation where you have uncertainty globally, you have uncertainty even on the domestic demand front, because if you look at urban wage growth, they have been slowing in real terms from the second half of FY24. And urban wage growth is very closely linked to how company profits are doing. So moment you see a slowdown in listed company profits, you can assume that there will be a slowdown in urban wage growth, and that's exactly what we are seeing. Even currently, when you look at the limited set of companies which have reported, the non-financial private sector companies, which have reported their results in Q4 FY25, there is a slowdown in profit growth. So urban wage growth is likely to stay on the weaker side, which will impact domestic demand. I completely agree with the panelists that that rural is likely to be slightly better. We are seeing pickup. But again, just because of that uncertainty, the fact that one, you don't know about external demand, you are seeing slowdown in rural, corporate profit growth is not that strong. We expect private corporate capex to stay in the sidelines or to remain tentative. So the weight again remains on the government sector to fill in that gap.
And the below 6% park, is that possible?
The GDP growth. So we've revised GDP growth by down to around 6.3. I would say, let's say the tariff goes back to that reciprocal rate of 26%. And at its peak, when China is 145, everybody else is getting targeted at their peak. Yes, then it can go to a 6%. That's a direct impact of the tariff because it automatically shaves off around 0.5 percentage points from growth. Then you have the second on effect, which is global growth slowing. So I wouldn't say no, but for now, our forecast is ranging from a 6.0 to a 6.3. A 6.3 is assuming a more milder tariff on India, let's say around 10%, what we are seeing during the pause period, and the higher tariffs on China, and you have a little bit of global growth slowdown. So for now, we are still saying a minimum of 6%.
Let me show you an interesting aspect here. We compared what happened in 2008 with now, and we got some very interesting aspects here. So world growth IMF had projected, this is a difference from the January update. IMF had projected world growth to go down by 0.5% in 2008. It's the same now. US growth was projected to fall by 0.9%. It's 0.9% now. It was minus 1%. China was minus 0.6. India seems to be somewhat better off in this scenario, Gaura, exactly what you were talking about. But even though the world is same, it's a bit different as well. Look at what happens when we look at next year. If you look at next year, 2026 and 2009, and difference in projections, global growth was expected to fall by much higher amounts for all these economies. India stands exactly the same as that. Coming back to the tariff part, Gaura, first to you, and then I'll go to Paras on this. The entire aspect is built on the fact that tariffs will kick in, India's tariffs will be lower, and services will not be impacted. US President Donald Trump yesterday moved towards the movie business as well. If services come in the fray, how much more the impact could be?
So interestingly, we keep focusing on though India is doing really well on the services front. If you look at our overall net services surplus post-COVID, there has been a structural change where net services surplus is almost countering your trade deficit on a monthly basis. We are seeing 16, 17, 18 billion dollars of services surplus, which has helped keep your current account deficit lower. But the interesting part is if you look at the trade with the US, and this is data from the US, merchandise, because it's a much older form of trade, it's India's merchandise exports to the US is almost double of India's services exports to the US. But yes, if let's say they start targeting the software side, then it will add on. And for example, if the merchandise hit at its peak is around 0.5 percentage points on GDP, if they start targeting the services, then at least you can add on another 0.2, 0.3 percentage points to that hit. But for now, we do feel that the services side is still protected from the fact that US's ability to replace that sort of skilled labor domestically is really limited. So even on the merchandise front, the fact that President Trump announced the pause, the fact that he is willing to do trade deals is because they also realize that their ability to replace the imports via domestic production is really difficult. On the services side, given the level of skill, the number of software engineers, etc., that you require, and the cost point, again, there India has a much higher competitive advantage. So we still feel there could be some non-tariff barriers. We are already seeing that in terms of immigration and the barriers to entry, but we still feel the services side should stay relatively well contained. And moment India reaches a deal on the merchandise side, that will also remove the risk that the US will escalate to services. President Trump is trying to protect, I would say, low-paying jobs, base jobs, while services is a very high-skilled niche sector in the US. So where, again, it's very difficult to replace what India basically can offer because of our demographics, because of the skill level, at least in that sector, we have a clear comparative.
Paras, what if services come into the fray? Also, a lot of our assumptions are contingent on India striking a deal. But we know the US president is also a deal maker. Relationships are now very transactional. What if he strikes a deal with China? Does that then put us back to where we were?
That's like the million-dollar question that anyone can answer right now. But then, yeah, in terms of back to the services part, yes, I concur with Gaura's view as well that we are much better placed in services, and there it would be, and also one important factor behind services is that based on the kind of methodology that they have applied to correct the tariff situation, the US has been having the trade deficit in the goods part since 1970s, but from that period onwards it has been having the surplus on the services front. And based on that, if you see, it would be very difficult also for them to put a blanket tariff on all the countries on the same methodology that they have applied for goods front. So there, I mean, that's the limited part that that would be protecting India in terms of services, and the services has been resilient so far, and with the kind of different capabilities, especially in other business services such as GCC and all, which is becoming a very critical component of various American business firms, especially financial firms as well. So it would be very limited for that matter. And if at all it were to be escalated, then definitely the impact would be
Gaurav, same question to you. What if he strikes a deal with China, right? Your mobile phone exports and your other exports, a lot of it comes from China at present. If US goes and strikes a deal or even reduces tariffs or goes back to the situation before 2024, are we on the same track back again?
Okay, if I think his main pain point is China. He has the largest trade deficit with China, and there's also a security threat that is being perceived by the US vis-a-vis China because of, let's say, in terms of technology, China is in the lead with all the, it files, I think, the highest number of patents globally. There is also a race over rare earth metals. And so, in my view, I would still say this whole trade war is not really US versus the rest of the world. It's US versus China. The reason why the second phase that was slightly different, for example, the first Trump presidency, he only targeted China. Then they realized that China was still able to export to the US, but they did it via another country. So now they're just targeting everybody, but the aim is still China. For example, the bilateral agreements that they are supposedly working on, they are looking at rules of origin. Where is the value added coming from? They are trying to ensure that what happened in the first term of President Trump, that reallocation of global supply chains, does not happen again. But if he reads, I guess if he reaches a deal with China, that means that he'll be completely fine with the rest of us. And then again, you'll have back to normal, no reciprocal tariffs, much more lower risk to global growth slowdown. So you'll see some mitigation. But again, I don't see that as very possible because the main target of the trade wars is China.